Listen to me. Are you ready? Because we need to have a serious, unfiltered reality check about your retirement, your money, and a massive roadblock that you might not see coming until it takes a giant bite out of your hard-earned life savings. If you live in the UK, or if you are planning to spend your golden years there, you are likely asking yourself one major, burning question: how much is my retirement income actually going to be taxed? You've worked 30, 40, maybe 50 years. You paid your dues, you paid your taxes on your salary, and you think, finally, I am crossing the finish line. The money in my pension is mine, free and clear. Wrong. It is a dangerous misconception that can absolutely devastate your financial security if you do not understand the rules of the game right now. Here is the brutal truth that almost nobody wants to face until it's too late. When you enter retirement in the United Kingdom, the government does not look at your retirement income as some special, protected pot of gold. No! To His Majesty's Revenue and Customs, HMRC, income is income. Whether it comes from a stressful 9-to-5 job, your state pension, a private workplace pension, or a self-invested personal pension, the taxman treats it virtually the same. The fear of running out of money in retirement is real, and the silent assassin that drains those accounts faster than anything else isn't just inflation, it is the tax drag you didn't plan for. Let's break down exactly how this works, step by step, because I want you to be safe, I want you to be secure, and I want you to keep what is rightfully yours. First, let's look at the baseline, your personal allowance. Right now, the standard personal allowance is frozen at £12,570 a year. What does that mean for you? It means the first £12,570 of your total annual income is completely tax-free. Sounds great, right? But here is the catch. The government has frozen this threshold all the way until 2031. With inflation pushing up everyday costs and forcing pension payouts to rise just to keep up, more and more of your money is being dragged into the tax net. This is what we call fiscal drag, and it is a hidden tax hike on retirees. Now, where does your retirement income actually come from? For most of you, the bedrock is the UK state pension. Let's clear up a massive misunderstanding right now. Is the state pension taxable? Yes, it absolutely is. While the state pension is paid to you without tax being deducted at the source, it counts 100% toward your taxable income. If your full new state pension takes up around £11,500 or more of your personal allowance, look at what happens. You only have a tiny sliver of your tax-free allowance left, about £1,000. Every single pound you draw from your private pensions, your workplace pensions, or your part-time job above that limit is going to be taxed. Once you go over that £12,570 threshold, you enter the tax bands. For England, Wales, and Northern Ireland, any taxable income between £12,571 and £50,270 is hit with a 20% basic rate tax. Think about that. 1/5 of your hard-earned pension income above the allowance goes straight back to the government. If you are blessed enough to have a total retirement income between £50,271 and £125,140, you cross into the higher rate tax bracket, where the government takes a whopping 40%. If you have investments outside of a tax-free wrapper like an ISA, the dividend allowance is a mere £500. Anything above that is taxed at rates that recently increased by 2 percentage points, meaning basic rate taxpayers pay 10.75% and higher rate taxpayers pay 35.75% on dividends. Your cash savings outside an ISA have a personal savings allowance of £1,000 for basic rate taxpayers and £500 for higher rate taxpayers, after which you pay standard income tax on the interest. I know this sounds overwhelming. I know it makes you angry. You are sitting there thinking, Susie, I spent my whole life building this nest egg, how do I protect it? Listen to me. Knowledge is power, and there are legal, powerful strategies you can use right now to fight back against this tax drag. You do not have to be a victim of the system. Your very first line of defense is the 25% tax-free lump sum rule. In the UK, when you access your defined contribution pension, you are generally allowed to take up to 25% of your total pension pot completely tax-free, capped at a lifetime limit of £268,275. But please, hear me on this, just because you can take 25% out all at once doesn't mean you should. If you take a massive chunk of tax-free cash and leave it sitting in a standard bank account, it will earn taxable interest, and the remaining 75% left in your pension will be fully taxable when you withdraw it. Instead, consider an UFBLS approach, uncrystallized funds pension lump sum, or phased drawdown. This allows you to take smaller, strategic withdrawals over time, where every single withdrawal you make is automatically structured as 25% tax-free and 75% taxable. By dripping the money out slowly, you keep your total annual income low, maximizing your £12,570 personal allowance and staying safely within the lowest possible tax bracket. If one partner has a large pension and is paying 40% tax, while the other partner has a small pension and isn't even using their full £12,570 allowance, you are losing money as a family unit. Look into balancing your retirement income or utilizing the marriage allowance, which allows a lower-earning partner to transfer up to £1,260 of their unused personal allowance to their spouse, saving up to £252 a year. The rules are always shifting. For example, looking ahead to April 2027, the government plans to bring in used pension funds directly into your taxable estate for inheritance tax purposes, which completely flips old legacy planning on its head. You can no longer just leave your pension sitting untouched forever as a tax-free inheritance wrapper. You need a dynamic plan to spend your assets down efficiently. Your actionable takeaway today is to audit your retirement income sources before the next tax year hits. Do not wait until April to figure this out. Calculate exactly what your state pension will be, look at your private pots, and calculate your projected annual income. If you are going to go over £12,570, speak to a qualified, independent financial advisor in the UK to structure your drawdowns. You work too hard for this money to let poor planning hand it over to the government. Stand up, take control of your financial destiny, protect your peace of mind, and stay safe.